All right, we're probably still going to have a couple of people drift in, but just want to welcome you to our session on finding capital. We have a couple of people who know a whole lot about this that are going to be speaking to us. Kevin Thomas works with an organization called Share. You were introduced to him in the keynote, and he specifically advises investors, companies, and a whole bunch of other stakeholders who want to understand investing better. And then Brad Bolton, who heads up a branch at BMO Nesbitt Burns, is going to just kind of chat with us about like what he's seeing today, you know, both in terms of investors and companies. So Kevin's going to just start us off with a little bit of, I think, 101, you know, kind of what are we talking about here, and then we'll be talking about just different trends that we're seeing in the industry and things that both companies, investors, other stakeholders need to know about how this industry is changing. And just one sort of housekeeping note as we're going along, do feel free to dial into Dialogue Loop if you like. We are asking people with all of the different sessions, etc., that we do, just to respond to those questions. What are you uncertain about? So, you know, what are the challenges? What are you curious about? What are the opportunities? And your way to do that, we'll have an opportunity for questions and comments at the end, but your other way to do that is through Dialogue Loop. And if you go into the Dialogue Loop and that login is on your back, you can just click on the back of your program, you can just click on this session and add questions there. Over to Kevin. Thank you.
Thanks, Angie, and thanks everyone for coming out here. I don't know if I'm right in the middle of that. Okay. I'll try and stay out of the beam hitting my eyes. I am going to run through a bit of a kind of 101, but mostly talk about some of the themes of the conference and how they relate to responsible investment in particular, and really about that interplay between companies and investors, which is changing dramatically, and how we're going to navigate that. And I wanted to start actually because I was listening to the presentation just now from Paul. I thought that was brilliant. Talking a lot about uncertainty and navigation and all stuff, and it made me think of the story that it's not a true story, although it was peddled on the internet as a true story. That never happens, right? But apparently there's a story about it. It's a transcript of this conversation between two ships off the coast of Newfoundland back in the 90s, supposedly. Although I hear it's actually goes even further back than that. But on the internet, this is the thing. Two ships off the coast, two lights coming at each other in the fog, and the first one radios to the other one and says, in order to avoid a collision, you're going to have to move 0.5 degrees to the south over. And the other one responds to it, says, no, you're going to have to move 15 degrees to the south over. And so the first one gets back and says, you don't understand, this is a U.S. Navy ship. You're going to have to move 5 degrees. I ask you to change your course now. And the other one gets back on, and by this time you can hear that I'm not going to do the Newfoundland accent, but for sure, strong Newfoundland accent, kind of chuckles a bit to himself and says, no, you're going to have to move. U.S. captain gets on and says, I am the captain of a U.S. Navy warship. We are heading directly towards you. You're going to have to move now. Accustomed to getting in the way, of course. And the Newfoundland accent comes back on the radio and says, we're a lighthouse. Your call. Anyway, I mentioned that actually, as I said, it's probably not true, but it does reflect a certain kind of truth that when you're navigating in kind of foggy areas, uncertain waters and all that, it helps to have a little bit of humility and be a bit open-minded about what you do and maybe engage in some really genuine dialogue with others. Otherwise, who knows what might happen. Now, the world we are in the moment, in terms of capital markets and responsible investment and corporations that are seeking money in capital markets, is actually very different than the one we have had for maybe 30 years prior. That is, the expectations that we have of each other are changing, the rules in capital markets are changing, the ideas that drive a lot of investors are changing. And it's not just because there is a lot of money now tied up with this idea of responsible investment, but even that the idea of responsible investment is very fluid. So when I started thinking I'm going to give you a 101 on responsible investment, I realized even that is kind of hard to do because there is no 101. There are many 101s. The most important thing, though, I start with is always that we have to get past the idea, which was first, you've probably heard this before, you first think about corporate responsibility or corporate accountability and how we manage these things, that what these new expectations are is just simply a bit of an augmented version of what happened in the past. That is, we're just asking for a little bit more of something, a little bit more information on environmental sustainability, a little bit more data on the workforce. That's not actually what's happening. We're having what we see as fundamentally different or qualitatively different expectations between investors and companies. Now, quickly, a little bit about my organization, Shareholder Association for Research and Education. We've been watching this happen and making it happen for 20 years here in Canada. Started out in Vancouver, trying to bring together shareholders that had the idea that what happens with the companies that they invest in matters, and that they have a role to play in trying to drive change with those companies and make sure that their portfolios, therefore, are more sustainable, inclusive, and productive as a whole. Now, we now have a network of maybe about 100 investors with institutional investors, that is, 23 billion in assets. We do shareholder engagement, that is, driving dialogues with company management and boards to try to change behaviors. We vote shares for our institutional clients, that is, elect the boards of directors, they appoint the auditors, and vote on shareholder proposals that are put forward. We help those investors do leadership development internally and trustee development and understand their roles and how they can play them out effectively. And we work, as we talk about cross-sectoral, we work at the policy level, both in provincial governments, with securities regulators, and with federal government. Now, at first glance, as I said, companies, when they first come across this idea of responsible investors asking for information, they tend to treat it as, we just need to provide a little bit extra information. It's just a slightly enhanced version of what we've done normally. I mean, how many people here know of companies that when they first got confronted with the idea of environmental sustainability as an issue, their answer was to hire one sustainability staffer and put a couple of lines in the annual report about how they care about the environment? I mean, I'm not even being really critical of that, because you can understand that thinking. It's like, well, is this just one extra thing we just have to do and it's not a big deal? Maybe. A lot of things come along like that, and you don't want to throw everything overboard and restart everything just because there's a different kind of demand on you. But that's definitely not what's happening. It's a very different expectation. On the investor side, though, to be fair, because I'm going to talk about the two sides here, investors and companies and where they come together. On the investor side, frankly, a lot of us have done that too. There's a study, there's two studies actually recently, which are quite interesting, one in the United States and one in Canada. And they looked at some of this new crop of sustainability related funds, ETFs and mutual funds and other things, that are pooled funds that are out there, vehicles for investment, that have added ESG or sustainability to their names, environmental social governance, just to go short form here. They've added that to their names and become a sustainability fund. And that's lovely, but they did these studies and said, you know what? A lot of these funds are exactly the same as their non-ESG counterparts. In fact, they just tacked the name on, didn't change a damn thing about the fund. They just changed the market. And that's definitely not going to answer the uncertainty that we're facing. It's not going to deliver that kind of authenticity we talked about for sure, but it's also not going to serve them well over the long term, because that kind of marketing falls flat over time. I can tell you, even from the example of Maria Eitel at Nike in the 90s, I was around for that, working with those apparel companies during that decade, and the first response they had was, we just have to change our marketing, they'll all be fine. That didn't work, and that's okay, because the companies actually got better by not doing that. They learned, and they fixed it, and they got better. Not entirely, but they definitely improved. So, we all know it's not really enough. Because the expectations are also not just about investors' expectations of the company and the retail investors, the beneficiaries of pension funds, other expectations of those investors. It's also really a changing dynamic in our relationship to the world around us, to regulators, to the actual economy we deal with, and to the ecosystems we deal with. Something bigger is changing here. Now, our securities law regime has been terrible for dealing with these changes. I have to pick on that for a second, because it's always been dealing with this idea of materiality. So when you think of, as a company, say you want to report to investors, what you're required to do by law and where we're going is quite different. What you're required to do by law is to use an index of materiality, an idea of materiality, to report important things to investors. The materiality, in a nutshell, is if the issue may cause a reasonable investor to change their mind or think differently about investing in or sticking with an investment, you've got to report that to them in a timely way. So all sorts of stuff, especially financial information, gets reported outwards to investors by law to make sure that we understand what's going on in the company. Now, that's not sufficient anymore in two different ways. One is, as I said, it's kind of dependent upon the reasonable investor. And I don't know about you, but I think the reasonable investor has changed. The definition of that investor has changed in the last 30 years. If you were investing in the 1980s, most people, there were some definite pioneers in this area of responsible investment, but most people weren't taking into account environmental sustainability or climate change and how they made investment decisions. Now that's changed. We've got something like I lose track of the numbers, $81 trillion worth of assets signed up to the UN Principles for Responsible Investment. And however deep their involvement is, that is significant in saying that a really major part of capital markets globally have said these things matter. And therefore, the idea of what is the reasonable investor, the normal investor looking at this stuff, has changed. So your disclosures and your approach to investors as a company has changed as well. The second thing is materiality is all about your company, individually in itself, on its own, as an island. But we've got other issues as investors now. For example, climate change. That's not a single company issue, that's a portfolio level systemic issue. And so if you just think about, say you were going to report on your ESG performance to your investors, well, some things might get on that list that weren't there previously because they weren't and still aren't really financially material to the company right at this moment. A good example would be greenhouse gas emissions. Now, that could be financially material to a company, especially if we get high enough carbon taxes in place, sure. But it may not be to a particular company. It may not be a particular thing that financially and legally they have to report. But for the investor who's trying to understand the impact and climate risks they face in their portfolio as a whole, that information may be critical to knowing something about how your company contributes to their climate footprint and their climate strategy. So suddenly that boundary between what you're reporting as a company based on materiality has changed as well. And just as we changed that, the boundaries of disclosure, the boundaries around corporate reporting and corporate governance have changed as well. I mentioned earlier that, and I think this is already well known, the Business Roundtable in the States making their statement recently that no longer are they solely beholden to shareholders, they have a responsibility to a broader group of stakeholders. Interesting comment from a group of leading CEOs. I'm not going to get into it right now. I have a lot of issues with this. So maybe after we're doing questions, we can talk about that. Maybe you do too, and maybe you can raise that. That's great, because this is the kind of conversation we probably want to have. But the funny thing about this, and I always have to say this because we're in Canada and we're not in the United States. The United States went crazy about this. Oh my God, this is amazing. Wow, what a big change. This has been the law in Canada for decades, well, a decade at least, more than a decade. Due to the BCE case at the Supreme Court, there was already a decision from the Supreme Court of Canada that said directors of companies have duties not just to shareholders, but to other stakeholders in that company, including the environment. That's been the law. And in fact, that was codified in law. I mean, that was a Supreme Court decision, so it stands as common law, but it's actually codified in law just this spring in the budget bill federally, where they changed the Canada Business Corporations Act, and they said that you actually have a broader duty. It was an interesting decision by the government. They said, you have duties that can go with the interest of shareholders, employees, retirees, and pensioners, creditors, consumers, governments, etc. Notice environment gets kind of big building on that. It's quite important. But actually, this is in a section talking about retirement savings and the decimation of pension plans when companies go under. So they specifically add retirees as a stakeholder you have to consider. Quite interesting. All that just to say that in Canadian law, that idea there's a broader frame of reference for what a company is responsible to is just the world we now live in. And that means that the old limited ways of thinking about the company and its relationship to investors and shareholders just isn't the same anymore. On the investor side, like I said, I'm going to go both directions. Our world's changed too. I deal with institutional investors, and mostly that means things like pension plans. And so for many years, pension plans had this idea, going back to the 80s from some legal decisions, you know what? You're not even allowed to think about these things like environmental issues or social issues, even governance questions. That's outside the purview of your duties as a pension trustee. And the reason was this thing called fiduciary duty. I'm not going to give a big legal lecture here about what that means, other than to say it's, especially in the case of pension plans, but also in cases of managers of funds that aren't their own, they have some duty to the people whose money it is, who you're managing, whose future you're managing, to actually act in their interests and not your own. And so this great fear was always out there that if you started thinking about environmental questions or social questions in investment decisions you were making, you'd be substituting your own moral values and judgments for good financial management. And then you'd basically blow the farm. You would lose money because these were money-losing questions. You might make decisions that weren't in the interest of the beneficiaries, etc. Fiduciary duty said, just don't pay attention to this. And then it changed. Started re-examining this idea and realized that environmental questions and social questions, how you treat your workers, what happens in the supply chain for Nike, for example, climate change, these all have, they're not just moral questions, they are. But they're not just moral questions, they're financial questions too. They're risks. They have an impact on the risk and return equation for this investment. So therefore, we're not changing the law here. We're just saying fiduciary duty actually means you have to think about risk and return over the long term. Well, that means you also have to think about environmental, social, and governance questions. We did a study not long ago looking at pension law in Canada specifically related to climate change. We've got some of the best pension lawyers in the country to look at this. And they said, actually, as a conclusion, I should have put this one up too. I don't think I have it here. Nope. I'll get to that in a second. They said that climate change denial was not an option for pension trustees. And in fact, the fiduciary duty said you actually have an obligation as a trustee to think about it. They didn't say you had to do anything particular about it. That is, you could think about climate change in relation to your investments and say, yeah, it's not going to have an impact. I'm not sure you arrive at that, but you could. If you did that analysis carefully and arrived at that question, that's fine. But you have to do the analysis because it may have an impact. And that's where we got to do as investors. So our world has changed too. The boundaries for acceptable practice as investors have changed. And our expectations of the beneficiaries or the owners of capital have changed as well. So here I'm going on, but the changes in the uncertain waters. What does this all mean for us if you're a company seeking capital or you're an investor trying to allocate capital and think about how that's done responsibly? What do? We've got a changing world. It's a bit foggy like that. Those ships at sea, this is not clear. There's no good signposts. There's no really obvious path to go on. And as I said earlier, the first question I always get asked when I meet with companies is, can you tell us what's the checklist that I got to do to access that capital? What's the thing which will make these responsible investors happy? And in fact, I get that from the investor side too. It's like, well, what's the checklist which says this is a really good company? Is there like just a bunch of indicators I can look at and I'm done? And there just isn't. And there's not going to be. There's not going to be one checklist that says that, or a set of data that can tell us this definitively, this is the way to go. Because it's changing rapidly. It's not even staying static. We have changing circumstances. So as leaders, really our job now is to figure out what are the principles we can work with which allow us to navigate well. So I'm going to use 5 of them. That's why there's little numbers up there so you keep tracking and you know when I'm going to be done. That's really good. 5 principles I'm going to talk about. And then I'm going to use one little example of how that plays out in a particular issue because I think it's helpful sometimes to get that down to the specifics. And then I'm going to turn over to Brad here, who's going to take it from there and make it all real. So that's really good. But let me start with this first one because this seems like, I'm going to say communication matter. This is going to feel like Mr. Rogers up here with something kind of trite. You know, communication's really good. Frankly, Fred Rogers was a genius, so I don't mind that, but I'm not going to quite do it that way. We talk a lot about communication between investors and the companies, between companies and investors. And as I said, the old rules around that for investor relations in a company was to go out there and tell the investors your story, what you want them to know about you. And that's not working. If you've ever sat in on a quarterly call with the CEO, it's deadly boring for one. Everyone has a packaged thing. The CEO says exactly what they want to say. The sell-side analysts on the call ask really trite questions usually, not all of them. And it's just kind of like a little show. Nothing much happens. That kind of communication isn't working. What we really need to move to is towards a dialogue in which you find out what investors want to know before you start telling them what you think they need to hear. That's really the first answer in communications. It's a dialogue. Now, I talked about materiality, of course, and the assumption was what's material is what we'll tell them, and everything else, none of their business. I kind of like what some companies have done. This is actually a few years ago. Maybe it's more recent, maybe it's a couple years ago. Bank of Montreal. This is doing a materiality map. So they went out to their stakeholders, not just shareholders, but customers and workers and I can't remember who else, government maybe, but they talked to a whole bunch of their stakeholders and said, okay, we know what we think is important, and we got a good sense of what's significant to us on the bottom axis, but what's important for you guys? What do you want to know? What should we be saying more about, and what should we say less about? And this allowed them to sort of map out when they start thinking about their program services and their reporting, what's going to be in there. Very simple tool, but it's cutting through that fog using that tool to no longer have a one-way dialogue right from the start. And for investors, again, going back to that side, I think it's incumbent upon us to be a lot clearer about what it is we're looking for, and more importantly, what we're going to use it for. I sat in on a meeting with a company, a large Canadian retail company, where it was with a number of large institutional investors. We were all around the table, and one of the investors was asking the company for disclosure. Remember correctly, it's disclosure about every factory in its supply chain. That is, tell us, we want the names and addresses of every factory in the supply chain, which is a demand coming from workers' organizations to try to build a bit of accountability into companies for being responsible for the factories they use. If you're linked to it, the tendency is going to be to try to make sure that factory is pretty credible and not pumping poison into the rivers or hiring kids or whatever it may be. So that's not a bad idea from an accountability perspective. But the company, to be fair, came back to the investor and said, if we gave you that information, how would you use it? What would you do with it? What difference would it make to you? And that was a good question because the investor didn't have an answer. Like, I mean, I wish they had a good answer for that, but really they didn't have the systems to use the data. They asked for it because they thought that's a good thing to ask for, but even if they got it, they wouldn't know what to do with it. Would they know if those lists, number 110 factory in there is a good one or a bad one? No. So it didn't. The information would have been a great exercise for the company to pull it all together, and then nothing. The investor decision doesn't change. So I think we have to be clear about what we want and why we want it, and then make sure we're actually using it. Otherwise, we get a whole bunch of information from companies that we don't know what to do with, and we're just drowned in information. I expect you're already drowning in information of all sorts. The last thing you need is more. What you need is better. And that's the reason we focus on communication first. The second one, which I like to point to, is alignment. And that's, again, getting to the depth. We're not just talking about now, what do we have to report? What's the little, can we just have 5 KPIs that we can report out and we're done with this? Can we just hire a sustainability person and put out a couple of nice photos of trees in our report and we're done? No, this is about alignment from top to bottom of the company, that authenticity of what it is you're doing. I'd like to talk about the task force on climate-related financial disclosures, TCFD. I always use the acronyms all the time and then you forget what they actually stand for. Task force on climate-related financial disclosures. Who here has heard of that or knows all about that already? Okay, a few. I will just then quickly say it's a global organization set up by the the Financial Stability Board, which was set up after the financial crisis to look at how to prevent financial crises. Mark Carney was the head of that, and Michael Bloomberg in New York, co-chairs. They instituted this working group to say, what do we need to know about climate risks as investors, and can we create a common framework for investors and companies to report on how they handle climate risk? And I'm not going to go into great detail about it, other than to say it was a really interesting and I'd say it's been widely adopted as the standard for climate risk disclosures, both for large institutional investors and for companies themselves. But what I wanted to bring your attention to is not the climate side of that, but just this kind of framework of how they looked at how you talk about, or how you work on and then talk about value of the company. They start at the top with this question of governance. So again, rather than just looking at a bunch of KPIs, they started with the board of that company thinking, okay, what is it about this issue that's either a risk or an opportunity for a company? How will it play out? What are the scenarios in which this is a problem for us or a good thing for us? How do we see this issue? And if so, is it an issue for us, and is it something that we can address in our business strategy? What's the interplay between those two? Directly related to business strategy. So I like that. It starts from the top about really what is this about what is it about this value or this issue that actually has to do with our strategy? And only then does it go back down to the risk management side of it, which is really getting down lower in the company and saying, okay, we know this is an issue for these reasons and in these ways, and it's going to impact our strategy in these good and bad ways. How are you going to manage that? What are the methods? What are the systems you're going to put in place to try to make sure that we come out on top of this, or we mitigate the risks if we have to? And only at that point do you start to get down to, okay, what are the metrics and targets? And this is that stuff that gets reported outwards usually. But first you align it top to bottom and say, by the time you get to this, you know where you're going, you know how you're going to get there, and now you're only thinking about how you measure it and report it outwards. There's a connection, top to bottom. That alignment is something which is way more important for your investors to understand than anything else. Because then they know it's not just an add-on for you, you're not just sort of tacking something at the end to your existing business strategy. You've actually embedded values, environmental, social, whatever they may be, into your strategy. That makes you a unique company. It makes you something that they understand where you're going and they want to hear your story. Top to bottom align, that's the first one. Now, that all sounds good. It's not easy to do, but it's sort of internal. The next piece, the next principle is really that outcomes are going to matter. And again, when you start talking about KPIs and that, key performance indicators, of course you're thinking about outcomes in your company. What's interesting in the responsible investment world now is that they've started to turn beyond the impacts in your company, the risks and the opportunities in your company, like how many accidents did you have, or what do your greenhouse gas emissions look like, that kind of thing, to actually thinking about, okay, what's your company's impact in the world? And you're getting an increasing segment of the market looking to try to define, measure, and invest in that impact. And it's not just that segment we call impact investing, which is kind of smaller and says we want to find like a social housing project we want to invest in. We'll get a slightly lower market return, but we'll get a great social impact we think is important. It's actually being expressed now in public markets as well, where investors are looking for what's the impact of this company on things that matter to us. I'll give you one example from our own experience. We engage with companies alongside a large group, again, with trillions of dollars in assets now, asking companies to account for their political involvement, their political lobbying and political spending, especially in the United States, which has a huge amount of money going into political campaigns. And we don't have that same thing in Canada, thanks to this whole thing called regulation. But it's still an issue here for lobbying. And we ask companies to account for that, especially when it comes to things like issues which are important to investors, again, portfolio-wide, things like climate change. How is this company, if it's got a great story to tell about its own climate change adaptation, mitigation, whatever it may be, but its trade association is out there lobbying against those very same things, there's a disconnect, and we want to see that fixed in that company. So it's not something which is again material to that company individually, but it's important for the investor to see that impact outside. Another one which I'll draw your attention to, of course, is the Sustainable Development Goals. Globally, that's set up by the United Nations, the idea of a number of goals which will help to eliminate, in their view, poverty globally, create more environmental sustainability, etc. More and more investors are drawing on those as guidelines for the kind of impacts they want to see in the world. And more companies are starting to use that as a guideline. Some do it a bit disingenuously. You'll see a company talking about its great impact on poverty alleviation because it provides jobs. I mean, yes, that's a good thing to provide jobs. It's just that you kind of have to do that anyway if you're going to produce your product or service. So calling that kind of like an extra impact that's really like above and beyond might be a bit stretching it, but I'm not going to take that away from them for the moment. I'm just going to say that there's this idea that there's something beyond the four walls of your company now which you have to speak to. Now, fourth one. This one I really think is becoming more important. It's one of the harder ones. Trajectory. So there's this thing called, I'll just use an example. There's this thing called, oh no, let's step back a second. Because the reason I like the trajectory thing is I always think of two different points. Actually, I was, many years ago, I was on a speaking tour with an indigenous leader in the United States. And he always talked about this thing. He was from one of the Plains tribes. And he talked about how they used to, when they would ride across the plains, well, you notice in southern Alberta better than I do, plains can be pretty flat. And sometimes it's not easy to navigate a pretty flat and empty surface, especially in the US plains, it's pretty empty. That's why he liked it, he said. But he said one of the things they learned, and he learned as a rider early on, was he needed 2 points to actually be able to do this. First, of course, you had to know where you're going, see that sort of long-term. You fixed on a point in the horizon you were trying to get to. But that wasn't enough on its own. You also had to have this point in the back you also had been coming from, that you fixed on. So you had those 2 fixed points, and that allowed you to kind of situate yourself, make sure you got where you're going. I haven't tested this out, so I'm going to trust that that actually worked for him. He got to the event and spoke, so I think it was probably good. He said we need both, though, the backwards point and the forwards point. The problem in capital markets is that we usually look to the backwards point only. And partly that's because the law tells us to be really cautious about forward-looking information. Things which talk about the future, when you speak to investors about the future, there's a lot of caution in there because you can be accused of defrauding investors if you start telling them, oh, well, we made lots of money in the past, we're going to make bundles of money in the future. It's going to be, I had an investment manager come up to me a while ago and tell me, guaranteed 500% return in 5 years, which was when I showed him the door, of course, because nobody guarantees a return unless it's maybe a government bond, and even then, but really, that kind of idea, you can't do that. So we shy away from forward-looking information, but the problem is we tend to spend our time looking backwards, and only one point is not enough. Let me give you an example of where this doesn't work well. There's a practice now in the responsible investment field we're seeing more and more of, where people carbon footprint their portfolio. So they'll look to their the bundle of companies or other assets in their portfolio, and they'll measure their carbon emissions, their greenhouse gas emissions, and then get a number for the entire footprint of that portfolio. And then what they do with that, some of them, say you're a mutual fund with a particular portfolio, you'll measure 1 year, and then you'll see if you can reduce that footprint by the next year. And that looks good on you because you're making change by reducing your footprint. I have a friend who works at one of these funds in Vancouver, and he came to me one day and said, I just think this is crap. And here's why. It's not that he's anti-environmental. In fact, he works for an environmental fund. He loves the idea of dealing with greenhouse gas emissions. He just thinks this method is terrible. Well, here's what they looked at in their portfolio. They had not published a carbon footprint for this very reason. They did the numbers, and they came back with one Alberta company. If they dropped this company from their portfolio, would make their numbers sing. It would look great. Anyone want to guess which Alberta company it was?
Concord.
No, actually, surprisingly not. I'm not sure. No, they were in a portfolio. Surprisingly, it was actually another one, Atco. Now, Atco, I don't know about you, I don't think that's a terrible company in terms of the environment necessarily. But, okay, Atco right now has coal-fired generation plants. Their carbon footprint's up here. But the trajectory they're on, as we know, they're closing those plants. Those are going to be gone. So is it the right thing now to say, yeah, you've got these things now, we know where you're going is going to be a better place, and so our answer to that is to drop you from our portfolio and punish you for going that direction. Because right now you're terrible. Even though you're going to get better next year, the year after, whatever it is, we're just going to drop you because it makes us look good. I don't think that's how we want to handle this, generally speaking. Similar today, I have one of my analysts is in Oakville meeting with a company called Algonquin Power. Renewable power generator, great company in all sorts of ways. In 2016, their carbon footprint was tiny, quite small, because they mostly had wind power, things like that. In 2017, it jumped up 8 times. They became, overnight, a big carbon emitter. What happened? Well, they bought a utility in the United States that has a coal-fired facility. And so suddenly they, like ATCO, are back up on that list, and you think, we better get rid of Algonquin Power, they're terrible. Well, they're a renewable energy company, so I think that might be one you want in your portfolio. I'm not going to give advice here about investment, but if you're environmentally conscious, you'd be looking at it and thinking about it. And what's the trajectory for this company? Well, they're closing down that coal-fired plant and building wind farms in the same state. And in fact, our dialogue with them has all been about how to preserve the jobs that they've got in that state. And one of the things the company has done is actually committed clearly and explicitly every worker that they employ there is being re-employed in that state and at the same level, benefits, pension, all that stuff, so that they're not going to have a negative employment impact from shutting down the coal plant. That's kind of a nice outcome. But again, if we just look backwards, that doesn't give us the right answer. There are some tools to look forward. One I quite like is called the Transition Pathways Initiative, coming out of the Grantham Institute at the London School of Economics. It rates companies against not where they are now in terms of climate change, but how resilient they think this company will be in terms of transitioning to a lower carbon economy. Some Canadian companies are ranked in there, not all of them, but it's a nice methodology for starting to think about not where we are, but where we're going to. Now, last point. Accountability matters. All this stuff I talk about, you always hear about a lot of this stuff, and it's all voluntary. I've been working with the federal government for the last few years on the question of a new law which will require companies to do due diligence in their supply chains around human rights. I think this is coming. It's been done in other jurisdictions. There's a lot of work being done federally on it. We had consultations across the country last spring, and more will come, I believe, once we get a new minister in place here. This is a good thing. At the same time we're doing those talks with the federal government, I've been meeting with business executives and companies that will be affected by this, and moreover, companies that have already been doing this work in their supply chains. Some have been doing a great job on that. And I asked them, how do you feel about a law that requires your competitors, you and your competitors, to meet this base standard of doing some kind of due diligence to root out human rights problems in your supply chain? Like, you're doing it already, so you don't have to change anything, but the law will require that as a baseline. And every one of them says, yeah, well, we're good to do this, but we don't want the law. Well, some of them are coming around on that, but at first, we're doing this, but we don't want the law. We want to do things voluntarily. We're afraid of accountability. Even if we're exceeding that baseline, we're afraid of accountability, that someone might hold us to these standards, that if one day we change, the regulations won't change with us and we'll be in a position where we're somehow suddenly offside. I think we're going to have to get over that one. Because the best companies have actually taken it upon themselves to find accountability measures, and they've been held to them and they've done well. One example, of course, actually on the investor side, is famously the Caisse de dépôt in Quebec not only instituted a carbon budget for its portfolio managers they had to follow, but they actually made their bonuses dependent upon actually achieving greenhouse gas reductions. Their CEO's bonus is tied into that. Accountability for outcomes, that's important. We've also got leading companies that actually look to external measures around ESG metrics, and they find ways to embed that in their executive compensation. They create board-level committees in which particular board directors are assigned responsibility for outcomes. One which you're seeing from investors more often than not, and why we have to pay attention to this, is that investors are starting to vote against directors if the results they're seeing from the company aren't sufficient on things like board diversity. If that board hasn't got some diversity and hasn't got targets and a plan to achieve that, some mainstream Canadian investors, RBC for example, Global Asset Management, have a policy of voting against directors because they haven't achieved some diversity targets. That's a good thing. That means we actually have some accountability one to another. And it means that the companies that embrace this really have taken on the idea, you know what, we're okay with this because we want to perform, we want to do well. This is about who we are and we're ready to meet it. So I have to wrap this up, I think. I was going to talk a little bit about Reconciliation Responsible Investment Initiative, which is really about a way of bringing some of these things together in one particular example. And that issue, which I know is important to Albertans, really is that question of Indigenous reconciliation and what's come out of the Truth and Reconciliation Commission. We have been meeting with companies and investors across the country to talk about this for the last few years, partnering with Indigenous organizations, and particularly with Indigenous trusts who themselves are holders of capital. Not because it's a material question necessarily in the short term for companies, but because it's important and it reflects certain kind of values. And interesting enough, that dialogue, the communication, explaining this is important to us as investors to companies, has opened a lot of doors with companies to dialogues which we didn't think were even possible before. Companies have stepped up to the plate to make changes themselves because they also saw it as important, but they didn't know they could talk about that with their investors. Communication. One of the things we've been raising with them is a question of joining something called Progressive Aboriginal Relations Program, which is something set up by the Canadian Council for Aboriginal Business. It's a systematic approach to Indigenous relations within a company, but it's also interesting because it's outcomes-based. Outcomes matter. So it has things like, how do you set up your procurement budget? Where do you find opportunities for that for Indigenous businesses? Indigenous employment, do we have any targets or ideas on how to improve recruitment and training, etc. It's also externally certified. You are certified against the program by an Indigenous-led board. So accountability. We're externally certified now, but we've got some idea that we actually have to perform over time. And most importantly, it's called the Progressive Aboriginal Relations Program because it's progressive. There's a trajectory to it. You're not expected to be great from day one. You're expected to learn as you go, show commitment to improvements, but you have time to do this. You have time to get better. People understand this. For us, as a signal as investors that the company understands this because they're on a trajectory. They've got some accountability metrics to it. They've got a way of us understanding what they're doing. And it speaks really to not just putting, in this case, a couple of drums in your annual report or some picture from a community you visited once, but actually having a sincere values-based idea of where your company fits in this national conversation. So I'm going to give this one thought. I said I kind of get asked all the time about what's the one and only true system to report. Is it SASB? Is it the Global Reporting Initiative? Is it something else? What am I going to do for that one and true system that gets me on right side with responsible investors? And we know that's not going to happen. It's too bad. For good and bad reasons, it's just not going to happen. So I go back to that sort of Newfoundland fog. We're going to be stuck in that for some time. And there's two ways you can deal with that. Obviously, from where I started, you could just try to steer straight ahead and maybe slight course correction, 0.5 degrees to the south, and just kind of don't listen to anybody, just see whether you can tough it out. And we all know how that's going to end. Or you can really enter into this process of dialogue with investors and investors with companies. Find a way to look to solutions together, change that trajectory, and hopefully come out of the other end with a much better solution. So again, I guess maybe as the lighthouse keeper said, your call. I'm going to leave it there and move it over to Brad and Angie. Please questions.
So I'm going to ask Brad a couple questions just about what he's seeing right here in Calgary, and then we will get Kevin to join us again and open it up for questions. So Brad, you head up a branch, well, the downtown branch for BMO and Burns, primarily dealing with investors, but of course you see the other side as well. What are you seeing shift in the industry? You were telling us about a conference that you were at a while ago, and just some new things that
lots of new stuff. And so when I hear a presentation like that, that's so well articulated, I have so many things going through my mind, it's hard to know where to start sometimes. And so when I say so many things, it starts with our retail investors. When I say retail, I'm just talking about all of us, individual investors, not institutional investors. And they are more and more now just really asking us questions. We have not been asked as much in the past about whether any of the holdings in their investment portfolio are not compliant with sort of standard ESG principles. And so that has begun to provoke us to step back and take a look at more and more of these investments and whether or not they would be considered ESG compliant. And it leads to really interesting discussions too. We've had one kind of recently about defense companies. On the one hand, we'll have investors who are aware that China just disclosed very recently, just within the last few months, that they have an intercontinental ballistic missile that will travel at 5 times the speed of sound. It will move like a cruise missile, which has never been the case with ICBMs before, and it carries 10 nuclear warheads. And it can hit the US in 30 minutes after being launched. And currently, and this was just disclosed in the last 6 months, and my brother's a veteran, so I call him right away. I'm like, he couldn't believe it. And apparently, currently, there's absolutely no sufficient defense in place for that kind of threat. And there's an entire island of those missiles pointed at the US right now. So some of my clients will be, well, who's going to capitalize from that threat? There's going to be some sort of defense that has to be brought to bear to prevent that from harming us in the future, if that terrible event was ever to happen. But other investors will be, well, I would never want to see any of my money in any kind of company that could have anything to do with harming people, defense or not. And so there's this kind of natural conflict, and it also exists, in the area of consumption, because some investors will be, well, I'll never touch, a nicotine producer. And that makes pretty reasonable sense, because it's pretty clear that a single smoke is detrimental to your health. Doesn't matter how many you have one and it's going to hurt you. But then on the same hand, in the area of consumption, you have some investors who feel that that doesn't apply to alcohol, because some studies indicate that reasonable wine consumption, I guess there are some people who just have reasonable wine consumption levels. So apparently that is actually helpful. I don't know exactly what that threshold is. Still trying to discover that. But apparently, reasonable levels of that kind of consumption can actually be considered healthy. So there's another conflict between investors. So you made me think of that when you were talking about how there's no sort of standard principles that any company can kind of try to follow, no checklist. And it's true on the retail investor side too. So as a general theme, we just sort of avoid all of them so that we don't have to spend a lot of time in those discussions, and because there's terrific opportunities outside of that space. On the capital market side, the conference that I had participated in, about a couple dozen advisors from across Canada at our firm go to New York each year to participate in a research conference in which about 30 analysts from JP Morgan and BMO speak to us over the course of 2 days. And I was simply astounded, at the unprecedented number of references to ESG and socially responsible investing, because I've been there the last 5 years, and this year it was exponential. I think 2/3 of the analysts referred to how they are both monitoring for it and they are consulting for it, because there is just, as you know better than I, more and more institutions, if you are not compliant on some degree of analysis, you are simply not on their radar for investing. And in a way, that's, I think, a really good thing. And the easiest way to, I think, sum that all up is if you go to BlackRock's site, BlackRock is the single largest money manager in the world. It's almost 8 trillion, which is a number you can't even. I should have thought of some clever anecdote about how many dollars that would take you to the moon and back, but it's just a number that seems surreal. But they run almost 8 trillion, and the CEO of BlackRock, Larry Fink, the kind of person who the government went to in the middle of the financial crisis to help get the world out of trouble, because their risk management program is so unique and sophisticated. He wrote a letter to shareholders, and I forget if you mentioned this already earlier or not, but he wrote a letter to shareholders this year and basically called them all to task, not to shareholders, to CEOs of the companies. And he said, your purpose, you need to speak to your purpose as an organization, and you need to identify how your company is going to essentially make the world a better place. It's not just about the investors, it's about stakeholders, it's about your creditors, it's about your employees, and really called them to task to communicate their values and their purpose. And in addition to that, he followed that at the New York Times Deal Book conference by saying something that really got everyone's attention in the industry. Because when he speaks, people listen. Anything that comes out of BlackRock gets a lot of attention because they are the single biggest market mover. But what he said was, over the next 5 years, every single investor, institutional investor, will use some kind of ESG overlay on their portfolios. And that, again, just speaks to the fact that if you have not addressed this as a company, you will simply not have access to capital in the future.
So how is BMO responding?
So BMO, it's quite interesting. I was so glad you asked that because I underappreciated a lot of the things BMO has done. And it's really intriguing. And I thought I would do something you're told you should never do in a public speaking environment, and have everyone pull out their phones for a second and actually go to, if you just key in BMOGAM into Google and search that, because I did this earlier, and I was so fascinated with, and if you don't do it, Kevin had actually mentioned RBC's Global Asset Management Division. So BMO has the same thing, and it's about $250 billion in dollars that are run. It's about $330 billion when you include the assets they advise on. But I went on there today, embarrassingly for the first time in many months, only because of you, Angie. And you know what is so great about that? As I thumb down there, one of the first things that comes up under key documents for BMO Global Asset Management is Modern Slavery and Human Trafficking Statement. And I thought that would be kind of warm to your heart, dear to your heart with all the work with IGM in the past. And how fascinating is that? I'm embarrassed to admit I didn't know that was on there. Then they have this official statement about how if you're a company that in any way could be seen to be participating or benefiting from any of those activities, you are not going to have it. And so it seems almost obvious to us when you hear something like that. But the reality is, I think in global markets, there's some pretty great areas about how are they labor sourcing for certain operations, aka sweatshops. And so BMO went kind of on the record with this statement that every one of the board of directors of GAM actually signed off on, which I thought was very impressive. But as you scroll down, on the same website, the homepage for all of BMO Global Asset Management, the next 5 highlighted articles, 3 of them are all about ESG. ESG Viewpoint, how the voting process went in Canada last year. ESG Viewpoint, gender diversity, are German companies keeping up? So it shows that they have a global reach and they are communicating and engaging with companies all over the world. And then finally, another one was ESG Viewpoint, access for growth in India, and insight on companies providing responsible access to healthcare and finance in India. So I was actually really proud as I kind of thumbed through my own company's website for the first time in months, thanks to you again, to see that on their homepage, literally highlighted 3 out of kind of 5 opportunities was really important initiatives related to ESG. And so that kind of feeds into what they're doing in their underlying funds. And they have done some really unique work. BMO, I think, is still the first company to have it's called Women in Leadership Fund. It came out about a year ago now. And essentially, and this actually goes to the keynote's address earlier today, in which he spoke about how if you do not have better gender representation, you get into trouble. He didn't really articulate, the statistics behind that. I think he said men are better at pushing a rock up a hill. I can't remember exactly, but there are statistics more profound than that. And I brought a couple which I thought were really interesting. Women, if your board has better gender diversification, and this is a study by Credit Suisse, you will have historically they have demonstrated 20% higher share price performance, 36% higher return on equity, 13% higher price to book value, and there's a half a dozen more variables I could rattle off. And so that issue sort of speaks for itself. And because if your board is overweighted by one gender, well, you're having a one-sided perspective. Both genders bring good things to the table. And so you need all of those good things represented when you make really important capital expenditure decisions. And if you have one gender and not the other, you're just going to make a decision that doesn't reflect, the best possible outcome. So BMO actually started a fund called Women in Leadership Fund, and I think there's an ETF as well. So they are responding to kind of this need with a number of unique products.
Now, what does this look like? Now, I know you're more managing now than meeting with investors, but I know you're doing it with investors to a certain extent.
50-50.
Okay. So what looks different? Like, is it significant in terms of investors asking? And then I'm also just curious. I'm curious about your investors, but I'm also curious about. It's all about the investors. So as the advisor, can you lead with sort of? It's some of the products. Like, can you encourage them to, hey, have you thought about all of these other metrics?
And so what we're finding, so a study came out in the last year that said 90% of millennials are intending or anticipate changing the advisor that their parents work with. And so as the manager of our branch, in addition to having my own retail practice, the largest transfer outs, the largest losses of assets from our branch typically are in situations where someone has passed away, a client has passed away, and the beneficiaries are not the clients of the existing advisor. And so exactly to that point, it is critical, and this is what I communicate to the advisors, that they had better engage with the beneficiaries and the next generation of investors of all of their clients. And one of the most powerful ways to do that is through a discussion around ESG investing, because that is the generation that is principally asking us more and more about it than ever before. And if you don't talk to them about it, somebody else will, and they will move their assets move around in our industry really easily until it finds a home and an environment that it feels relatively safe in and getting good service. But more important than ever is that it shares values with the person. They trust that kind of trusted relationship that they share values. So it is critically important to be not just waiting for those questions, but to be engaging clients about those questions. Because most of the time they're thinking it, but they just may not bring it up.
And they might just leave.
That's right. You don't want that.
Kevin, why don't you join us again? And so I wanted to open it up for questions, comments. I also want to encourage you, I know that we have folks in the room here that are connected with other banks, investment advisors, etc. You're welcome to make comments, but I also encourage you on the Dialogue Loop platform. If there's another, investment, we want to be practical. So if there's other investment opportunities that you know of, feel free to post it there. Do advertise for yourself, that's just fine. And part of the practical component of Soul Forum is we want people to be able to leave with actual, hey, there's something that I can do here. But so you can do that on your phones, and we're going to collate some of that information. And again, just click on this session, and then there's the second tab over on the bottom is a comment box. But questions, comments, go ahead, Brent.
Yeah, I'm just curious, because both of you would have a very good perspective on the sort of the investment ecosystem globally. how far are we away from having all investments ESG related? You know, we talked about labeling, not true, but we want to have, you know, truly ESG compliant investments in terms of funds and trusts and things like that to invest in. It seems like it's growing at such an exponential rate. Is that the norm now, as opposed to not responsible investing? And where are we on that continuum?
So my positive side says it's becoming the norm. That is, we ideally get to the point where it's just investing, not, it doesn't need to be labeled because it just works. I don't think we're really there though, because there is a depth to it that still needs to be there. You don't want, there are a lot of, like I said, 80 some trillion dollars, maybe it's 90, signed up to the UN Principles of Responsible Investment, and then UNPRI says, yeah, actually, but a lot of people are not walking the talk. So I think we've got a lot of work to do on the depth side, but the consciousness that this is legitimately part of the investment process, that I think is hitting to being the mainstream norm. It's just not practice. There's people that pay a lot more attention to that than others.
Patty, I'm going to pick on you for a second. I know this might not speak to the depth, but what was that statistic that came up from Responsible Business Investment Association this last year? Like something to the effect we were at the tipping point of investments.
Well, they come up with a report every 2 years on assets, and so the assets have grown exponentially. It's like a hockey stick graph, and so there's growth because demand for institutional investors such as pension funds, retail investors are asking more, and there's more product available. So it's it's online. Actually, it's a really good source if anyone is interested themselves to find out more about responsible investing. It's Responsible Investment Association of Canada, and there's a whole marketplace area on product that's available, statistics. It's excellent. I've been on the board for 9 years, so it's a good place
Probably
to go.
should do my talk right now.
Go ahead.
Just on the question of depth, then, so how do we get more depth? What's your take on an approach to that?
Well, I think an individual fund has got to do a bit more of its own homework internally. That is, the best ones have done training down from not just from putting in the marketing bit, but have done the training for the portfolio managers and acquired the right kind of data, created in internal sort of bespoke systems to analyze the data properly, because even the data is not quite good enough. And where I see the best depth happening is where they graduate to this question of active ownership. So it's not just selecting what's in the portfolio, but then we've got these companies in the portfolio, and now what do we do with them? How do we vote when issues come up on the ballot? How do we engage with companies in between annual meetings? I'm not just saying that because that's what we do for investors, so it's a great sales pitch, but it's actually, I think, where you start to see some of the more fundamental changes happening. And it's becoming a practice that's more widespread. One of the criticisms of Larry Fink and BlackRock is that the great comments come out, and when he speaks, it's really influential, but the voting record of BlackRock is terrible. So we need to do some work there. In fact, there's a shareholder proposal at BlackRock to account for its voting record this year. So it's an interesting thing between responsible investors going after other investors to try to improve practices. I think this is all good. We are no one is doing this perfectly. So we all are in learning mode, and that's a good thing. We challenge each other and try to find ways to do it well.
Sort of, I don't know why that reminds me of that scene in The Incredibles. Anybody who has children ages of mine is probably going to remember that moment where the villain says his goal is to make everyone super, because if everyone is super, then no one is. And so the reason I think I'm reminded of that is, how realistic is it that everything does become ESG compliant? And maybe it is, and maybe, you know, in a kind of a noble pursuit in that regard. But you'd think that there would almost always be some way that some companies could really differentiate themselves. And in fact, I would undoubtedly, if all companies met some basic standard, then undoubtedly others would look to set themselves apart by setting even higher standards. And so there'll always be hopefully a sort of attempt to attract capital by being the best you can possibly be. One statistic I did just dig up kind of to the earlier question was So assets in sustainable investment-related products reached 30.7 trillion. That's an unbelievable number. At the start of 2018, that was up 34% from the beginning of 2016. So kind of to your point about, I mean, yeah, according to this, nearly 50%, and this is, BMO's quoted this from another study, nearly 50% of assets in Europe are considered in some form of sustainable investment product. So higher than I would have guessed, actually.
Go ahead.
I would like to ask the question about resilience. So I do think that your 5 principles are really key and can be applied to the question about what companies or how you build a resilient company and what are those qualities. Is there anything else that you would add to that? If the question to you is this company going to be resilient?
I mean, probably a lot of things, but if I try to get down to just a couple. I talked about trajectory in terms of your thoughts about your governance and things like that, but I think one of the things about trajectory is always capital expenditures. So where's the money going towards the future? And how are you sort of future-proofing in the thinking about what you do with your capital expenditures? What are you investing in now? And I say this because we deal with climate change a lot, and one of the worst things we see is where a company locks in emissions over long term by investing in things today that may not be good investments 5 years down the road. The other thing, which I think is, I get this from companies a lot, is the question of resilience. Is really resilience in that interplay between the investors and the company. You get companies saying, you know what, I wish we had more responsible investors in the room and long-term investors. We want the long-term ones, and yet we're plagued by these short-term traders that short our stock or just are in here for a month or two and then gone, and that's not the investor we want. Resilience has to be kind of that, most resilient ones have that kind of supportive long-term investor involved because that allows them to experiment a bit more, to be creative, and not fear that immediate backlash. So if you want that kind of investor, you have to actually seek them out. You have to be providing that kind of information, dialogue, and value proposition to them that speaks to that long term. So
could you make a comment then about how that could be applied to the economy in Alberta?
How it can be applied to the economy in Alberta? Well, the issue with resilience then in Alberta comes down to that diversification, which we all want, and have always wanted, and it's been hard to do. And I worked for probably about a decade up north in Alberta with an oilfield services company, an Indigenous one, so the sense of how difficult it was to even diversify that part of the economy based on what was there, and the what do you call it, the vulnerability that we had to the ebbs and flows of that market was just horrendous. So I'd start there, but I think we also need to be able to tell a story about all the other great things Alberta has going on to global investors, because all they ever hear about Alberta is oil sands, oil sands, oil sands. Pro or negative, that's all they hear, and you know better than I mean, Alberta's got a lot more going on that's just not getting the same investment. The other thing I want to be pushing, and when we talk about just transitions, and that idea, when I talk about that company that's make sure all the workers get a job when the coal-fired plant goes, we need to also be working at the policy and public policy level to make sure that there are what we call place-based investment initiatives, so that we're actually getting investment dollars incentivized to come in here and build those alternatives. I think that's a job for investors. It's a job for Alberta. It's a job for the federal government, for sure. And it's something which I think, if we're going to be serious about changing our economy and at least adapting to the changes that are coming to us, that's going to require us being actively involved as investors in policy.
When you speak about investors, and at the beginning you talked about shareholders, and it just not being the shareholders who get the dividend, it's all those around, being climate being one of those. But one of my oil and gas clients will struggle with the structure of government. One piece of government says carbon tax, one does not. So then they have louder voices that then speak to multiple different investors, and then it becomes a global piece too. How do you feel that really important stakeholder, the government, to whatever level it is, provincial or federal, echoes effects and has a disruption around investment. So what I'm basically saying is, how can you do business sometimes if, like, so my oil and gas client has gone to like greenhouse gas emission reportings and all those things. But when they put stuff out, they can be criticized on two ends of being pro carbon tax or non-carbon tax, so that they have multiple shareholders being large investors in Europe. What are some key messagings that people could use to manage that at a company level? How would you handle that?
Well, I'm a bit cautious about this because it's not all solvable at a single company level. I mean, I'll get to what maybe an individual company handles some of that, but I do feel like it's a bit unfair to each company to say, you now have to be somehow the champion for all of them to fix it. I do think that there's a role for companies to play in the public policy arena. They do already, but there's a group coming together of CEOs, I don't think it's launched publicly yet, but I'll say it anyway, that is trying to speak to this certainty around the climate policy. The biggest problem for them is not that there's is or is not climate policies. They don't have any certainty about what's happening. And it's deadly to try to run a business without at least some consistency in what you're doing at all levels. So that I strongly encourage. I also think the investors have got to speak to that too, because we should be allies on this. We want the companies to succeed in the long run. But I feel on the individual company piece, it's not going to be effective to try to straddle the middle on that. And you're going to get criticism for, you put out your carbon footprinting stuff, and you're going to get criticism from some that say, oh yeah, you're talking about greenhouse gas emissions, therefore you're now, you're bad for the oil patch. We're all supposed to stick together. Frankly, I think if you're going to be forward-looking on this, you've got to come out with that and say, yeah, we understand as a company that there are transitions happening here. We want to be part of that. We want to figure out our role in that. We're not the enemy on that either, but we're not going to be changing overnight either. So I would own that personally. You're going to find some investors that leave, but there's a great pool of investors out there that are just hungering for somebody to be honest like that, and they look for it. So as I said, I was seeking out the investors you want. That message is part of that.
One of the most painful comments at this New York conference was before going to the JP Morgan offices, we had a morning session with a consulting company of hedge funds. And it wasn't part of their formal presentation. It was during the Q&A, and about a half dozen of the participants are Calgary-based advisors, my peers. And one of them asked about Calgary Energy, what appears to be deep-seated long-term value on almost any measurable metric on a historic basis. And this consultant, who is very influential amongst New York hedge funds, couldn't even help himself but laugh. And it was so heartbreaking, because in that one chuckle and his following comments, you had a real sense of what the rest of the world thinks of our oil patch. And he mentioned flying over Vancouver just the week before, and seeing the Trans Mountain, a portion of the Trans Mountain pipeline, and he's like, I don't want you to take this the wrong way, but you Canadians can't even twin an existing pipeline. You can't even twin the one that's already there. There's not a lot of damage that's going to be done by adding to the existing. You can't even do that. And then there was some, visceral reaction from this advisor trying to say, well, this and this, and he said, we've heard it all for decades, and we're done. And it was like, oh. And then Canada leaves, and you're like, we have to do a better job diversifying this economy, to your point.
And communicating about it.
Well, that's exactly the breakdown. It's so painful when you go to a great city like Seattle, which I travel to often because I'm a huge Hawks fan. But you go to Seattle and you have a dozen global dominators from completely independent industries. Amazon, Microsoft, Starbucks, Nordstrom's, Boeing, UPS, and it's unbelievable that they have attracted those global dominators from completely independent sectors, and we have won. And we just have to tell our story better. And it would help if we had lower taxes and less winter, but but we still have a lot of great characteristics about this.
So outcome of this session, we need shorter winters.
Yeah, exactly.
You can stick around and ask questions, but I'm just going to kind of end the formal session and say thank you to our guests.